Welcome everyone to another question here. We have fair value measurements. Let's run through what we need to see here, what we need to prepare for, and we'll get started. McClave Enterprises used quoted prices for similar assets as the basis for determining the fair value of its investments. McClave's inputs for determining the fair values of the investments would be classified as which level in the fair value hierarchy? All right, well, the fair value hierarchy you should be familiar with, and if you're not, I have it here for you. And, well, what's the first thing you notice? First thing you notice is there's no such thing as a level 4. That's a distractor. That will always be wrong. Let's go through examples. Level 1 would be stocks. You can immediately look up and see stock prices regularly updated, the fair values online on Google, anywhere like that. Level 2 is observable prices, meaning, okay, I don't really know how much my house is worth, but if my neighbor's house right next to mine, which is pretty much the same house, and just sold for $200,000, well, I can use a level 2 input, call it that, and say, okay, my house is probably worth $200,000. Lastly, level 3 is anything that's unobservable prices. This would be an amusement park that is super authentic, unique. This would be something so out there that you just can't compare to anything else, really. Maybe this is the cure for a disease. You can't really put a price on that, right? You don't really know. You don't know how to value it based on another input. Now, what do we have here? We have quoted prices for similar assets. If it just had quoted prices, that would for sure be level 1. But because it says similar assets, that's going to be a level 2. It's not going to be a level 3 because there is something to reference. So final answer here is going to be letter B, level 2. All right, moving on to our next one here. We have a situation where during year 3, Gilman Company purchased 5,000 shares of the 500,000 outstanding shares of Meteor Corp for $35,000. During the year, we received $1,800 of dividends from the investment, and the fair value of the stock at year end when we're reporting for is $32,000. Okay, some initial thoughts I have is we bought for $35,000. Gilman has elected the fair value option for the investment. Now, the fair value method, as compared to the cost option, the cost method, this is going to be normal, right? This is going to be normally what you would think of. So normally, what is the gain or loss from this? It was $35,000. Now we're at $32,000 of value. So we have a loss here of $3,000. However, we're not done yet, because we also received dividends. Now, yes, we're down $3,000, but these are locked-in gains because we received this already. So we're actually going to add $1,800 to our losses, which now it's not really a $3,000 loss. If we net these together, it's actually only a $1,200 loss. And that's our final answer here. That's what we're going to have. Yeah, so this is the process for the fair value option for measurements. Net effect, we're going to net everything together. We are going to take it all into account. Any dividends, any distributions, any increases or decreases in fair value. What's our overall net result from this investment? All right, that was another question here. Going to say again, thank you all for joining and hope you're doing well. Keep going strong. I have faith, and you'll get through this test before you know it. Keep going strong, and I'll talk to y'all later.